So I'm Henrik. I'm one of the partners at Playfair. I've been here for almost 5 years now. So I joined at the beginning of the second fund, and I kind of worked my way up through. We're a pre-seed fund that aspires to be sort of like highest conviction fund in that category in Europe. And what that means is only doing 6 investments a year, and so going a lot deeper on understanding the markets we're investing in, the problems that the companies are tackling, and then ultimately like the founding team and how you guys are working on building that company. So what we do is try and go deeper with you, but also go deeper outside and end up doing like 10, 15 founder references kind of around the side, just like build this picture. And it helps us pick better, and it helps us actually then get, I don't know, deeper with you in those like small but also macro discussions that end up happening on the first couple of years of pre-seed to A. So our North Star metric is, can we get 75% of our companies from pre-seed to A? Industry average is about 20. So that's kind of how all of that work like comes together. The boring facts are we invest all across Europe. Our ticket sizes are anything up to 1.5 million, but we basically aim for 10%. So whatever your round is, it kind of depends. And we'll invest in literally anything apart from biotech and gaming. But otherwise, yeah, we want to be founder-led. So you guys are the experts.
Cool. Edel, go ahead.
Thank you. You can hear me okay, yeah?
Yep.
Hi, my name is Edel. I'm a principal with Molten Ventures. We are a London headquartered pan-European venture capital investor. So we do Series A and B predominantly. We do about 10 to 12 new deals a year, deploy about 120 to 150 million pounds in any given year. So in the European context, fairly large, fairly deep-pocketed. We're a sector agnostic fund. We're about 60 people altogether, but kind of 50 and 20 on the investment side. I'm just the tip of the iceberg. We also have a platform team that works very hands-on with our founders as we travel through the journey together. Boring facts. Done. I sit in our Dublin office. Everybody else, other than one person, is in London. And I think what makes us slightly different is we've been around under one brand name or another for quite a long time, so coming close to 20 years now. So we've got a long history of backing what we believe to be global winners, just happen to be started in Europe, and work very closely with them as they scale globally. So that could be more often than not into the US, but also we do the same heading east into Asia. That's kind of it. I spend a lot of my time in enterprise software and deep tech, but again, we'll look at anything. I'm also a generalist, so I tend to be spread across kind of deep tech, enterprise, health, the odd bit of consumer. So basically interested in everything you guys are working on, and kind of looking forward to doing more up in Belfast and hopefully with some of the folks in the room.
Awesome. Okay. So, hey George, how are you, buddy? So we'll just do questions. So we will. So does anybody want to kick us off and not be shy? Just question. Who wants to go first? Yes, good man. Love it. Go ahead.
Hi guys, my name's Owen. Company's called Head Coach. It's about building emotional intelligence skills in athletes and coaches in the pro football world and pro sports. I'm just curious, a couple of questions here. So first one really is, we're pre-revenue. Our app's going to be doing a soft launch here next Tuesday. At the minute, we have 2 co-founders who are full-time on the business, and a third one, for financial reasons, is currently still employed at his old job. So I was just curious, at a pre-seed round, is 2 co-founders full-time on the business okay, or would we required to have all 3 co-founders full-time working?
I'd say that in general, what investors are really looking for is people that are committed to like a 10-year journey to change a category. And so I suppose the answer is, really answering that question more than like, does it check a box of should you have 1, 2, 3, 4, however many co-founders? I think, if I wanted to back someone, and, personally, I'd only ever lead 2 investments a year. So I'm like, you are one of the 2 people a year that I'm going to spend like the next 5, 10 years building with. I'd want like that full team to be fully invested. And if, one person is sort of, basically you should be raising enough that all 3 of you should be able to go full time. And if there's maybe some reluctance, it's maybe there's something else going on, you don't fully believe in the mission, or maybe you're not raising enough, there isn't enough support, etc. And so I'd think of that as quite an important sort of signal. At the same time, there are circumstances, we have one company I can think of where, it's more of like a health business, and, one of those co-founders wants to maintain 1 day a week, still working in the NHS and kind of giving back that way. And so that's totally fine. That's important to them and it doesn't impact the business. So I think there's, areas which you can compromise. I think someone just doing a full-time job separately, but wanting to still have the co-founders sort of cake and eat it. That's probably what I'd say. I hope that helps.
Yeah, no, that helps a lot. Thank you.
Do you have another question, or was there anything you said?
Yeah, sure. Do you want me to keep going? Okay, cool. So, as I say, we're pre-launch. We're going to be launching next Tuesday and starting to think about doing a pre-seed round here in the next 6 months. What sort of data would be required in our data room at this stage of a business? Obviously, we're looking at DAUs and things like that, but is there anything additional that I probably wouldn't be thinking of?
Yeah, like giant financial model, pages, and no.
So yeah. Sorry, you said about the financial model there, so that's another good question in terms of how to project future sales and how confident you would be on those things. So should you be including those in your financial model when you're trying to do a pre-seed round, or should you just focus on covering costs at a pre-seed round?
Yeah, no, I was fully joking about the giant financial model, just to be absolutely clear. I think it honestly really depends. I know I will answer your question more directly, but I think the data room should be like supporting the story. So the first pitch is always about like telling the narrative, getting someone bought into your vision. It's maybe not giving all of the details, because actually you can't tell a story if you're just like dredged in the details. But then someone needs to go in the data room after like the second call or something and say, okay, you talked all about like this amazing pipeline, but let me actually see who those people are. Let's see like what category they fit into, how much like they could potentially buy. In the financial model, I want to see what does a theoretical pricing structure mean, so that at Series A we could actually get to X margins, or we could actually reach certain milestones. It's more, I see it as like a validation of the story that I've bought into at that first meeting or second meeting. So, that's kind of like really, I'd say, my answer in terms of like just helping you think about, okay, what are the things I definitely should include? In the data room, you should have some kind of financial model, but I'd say it's basically like a cost model. I'd say that's probably what's more important. It's like essentially a hiring plan with maybe office space, with a bit of a buffer, and then like very simple, like, here's what I'm going to charge, here's how many customers I'm going to have. Like, I'd say more or less, like I'm simplifying, but that's pretty much the financial model. I think then you should have some detail on your like pipeline or customers if you already got it. I love seeing like market size work. Like you've actually done some like bottom up market sizing work. Maybe that'll be a follow up question, but I won't go into it now. And then what was the last thing I was going to say? Yeah, just like understanding of customers and the problem. Like if you've done customer interviews, try and condense that and put it into the data room so that I can understand what you've understood. You've spoken to like 10, 20 people. What are some of those like key messages you pulled out? Maybe even some of the transcripts of some of those calls, if you can anonymize them. That's really, really helpful, but definitely not necessary.
Okay,
Hope that helps.
That's very cool. All right, thank you. The last question I had there was around vesting schedules and how something like that works at the pre-seed level. Don't know anything about that really.
Yeah, it'd be interesting to hear what you expect later as well. I think these have changed a lot in the last few years, particularly in the like heady days where vesting schedules started to get cut down and down and down, and a lot more power is on the founder side. I'd say I hesitate to put like too fixed a kind of thing on this is what standard is, but like a 1 year cliff is quite sensible because it like really gives people like that, if things go wrong, which they often go wrong sooner rather than later, it gives you that like 1 year buffer. And if people are in it, then like after that year, it's as if it was vesting anyway. I'd say like 3 years is usually like pretty standard, maybe 4. So anything around that. You definitely want to have vesting though, like full stop. I think people think it's only an investor protection, but it's also a founder protection. So we've actually seen scenarios where there wasn't vesting in place and one of the co-founders fell out with the other co-founder and the business is basically screwed because that co-founder, they have the right to the shares and they have no reason to give them up. And it's essentially an impossible negotiation. Like, can you give back 90% of your shares, please? And they're like, no. And then what do? You basically have to then like start a new company and kind of do a pre-pack. It gets very complicated. So yeah, I'd really recommend like proper founder vesting and understand it from like this is pro-founder rather than just like pro-investor.
Yeah, I just agree completely. There's not much else to add. by the time it gets to Series A, probably the bigger question on your mind is going to be around whether or not you're going to be asked to reset the vesting schedule. That also totally depends. There's not necessarily a standard. Like if you've been, say it's a deep tech business and you've been working on it technically since, 6 years ago, but you're only really potentially getting towards commercialization, you're probably going to expect that there be some level of like investor requests for that to be reset to some degree. But I wouldn't worry about it. I would think about it totally as a protection for you and for your other co-founders, and same across the board with your employees. I don't think you need to put like a proper super firm ESOP in place on day one. Don't overthink it, but just make sure that if you are granting options that there's some sort of headline 1-year cliff, 3-year vesting, so everybody knows what they're getting into.
More questions? Who wants to go? Yeah, Paul, just intro yourself as well.
Hi, Paul Malloy, Trimedica. I guess the question for me is what's the 3 key things that gets a conversation with you guys?
Show us you can make us money would be the first thing.
Brilliant. That doesn't seem to work.
Yes.
Keep going.
Put that in the email. Do you mean kind of as a cold approach?
Absolutely.
Or?
I mean, what I'm finding, if I don't have a warm introduction to a VC, it doesn't happen. The info-ats and all that stuff, you don't get past that barrier.
Yeah,
so
you do with Playfair actually, but not with many others. So I don't know. I would. This is maybe an annoying answer. Try and find a warm intro. So you're here, which is good. So you've kind of done that work already. I think it's about that storytelling. So get to the point quite quickly. So if you're building a venture scale business, you should be able to articulate how big the problem you're solving is, and therefore how big the prize is when you do solve it. I think that's the first thing. So it needs to be big. So big problem, big ambition. That's normally the first thing for me. And then are you doing something, this is my bias, but are you doing something technically difficult? So whether that is, like deep tech, or whether that's kind of in health and life sciences versus kind of a Me Too product, let's say, but you're going after a different niche in the market. I think showing that you've got something that differentiates you from a technical perspective, or having that unfair advantage of having lived the problem, that's kind of good. Bring that up to the surface quite soon as well.
Yeah, I appreciate the shout out. I suppose I'll comment on Playfair's side, but also on the market. I think the reason that most people don't respond to the investors at inbox or the intros at inbox is just there isn't a process and there isn't the time. People just basically don't have someone dedicated to that. They haven't built something, and we decided, just because of the way we like to see the market, that we want to dedicate that time. And so we built basically like a product behind the scenes that allows us to, we get 5,000 a year, and we have like 1 or 2 analysts that spend maybe 1 day a week kind of managing that. And we've ended up doing 2 investments out of the second fund, so 2 out of 25 from that channel. So it's worked for us, but it is a huge time commitment. And so it is like something that I'd say most funds will just probably never do. I hope maybe they will change, but it's just realistic. There's actually there's a list. I wrote a Medium post about this maybe 2 or 3 years ago. You can probably find it quite easily, where I list like the other funds that do it. I now forget who they are, but I have shouted them out, so it's there. So there are a couple of others. What I would say is that true cold inbound, i.e. not through like a website type form or whatever, literally a LinkedIn message or like emailing, finding someone's email address. I can only remember maximum 10 that were ever personalized, like truly personalized. And I've probably had like thousands, like genuinely thousands. And like one of them we invested in. Like the recycle I found has emailed me when I was actually on holiday, and I only opened it because like the first line was like, I was like, oh, this person actually, like, I don't know who this is, but they know me. And I was like, that's weird. Like, it made me open it. And they'd researched like 2 of our companies that use computer vision. They thought it was really interesting. They had a comment on actually why they thought maybe it was an issue or something. And then they went into their like pitch, and I was like, well, it's definitely worth speaking to these people. They've done their research. So I'd almost recommend reach out to like 10 times less people and spend 10 times the amount of time researching those fewer people. And you'll actually notice that a conversion rate will change hugely. Well, come back to me when I'm next here and tell me I'm wrong, but I doubt it. I think it will work.
I agree. Just to add, like when we're outbounding, we have to do the same thing that you guys are doing. So we spot a company that we think is really, really interesting. We don't know them. Maybe we've tried to find a way in, we couldn't get in. Maybe we've tried to find a way in and we've gone direct. It all takes time. So that's why it's worth picking the ones where you think you actually have a fit, that you're, could potentially, can you see yourself in their portfolio, and just spend the time personalizing, yes, but also saying why you're a good fit. Not just, hey, I've seen you've invested in, Binalize Voltry, I'm a cybersecurity company. It's like, when I'm outbounding, I have to talk about what my thesis is on the space that a company is in. And so if you reverse that, it's just be a bit thoughtful about the why.
Nice. Go ahead, Steve.
I've been told to do an introduction to the question. Are we operating under Chatham House rules?
Sure.
Whatever.
Oh,
yeah.
okay.
Sure.
No, so I'm Steve Berry. So I'm chairman of Angoka, which is a fairly robust company. We're 40 people here in Belfast. And we do smart mobility, drones, autonomous vehicles. My question is, how do you keep your VCs honest? So, and what I mean by that, so our comparables in the States or Israel will be probably 50 to 100 million valuation right now. And we've got 3 very good VCs, but they're trying to talk us down in terms of what the valuation should be, which is quite a disparity between what we think it should be and what they think it should be. So any tips to the trade in terms of how do you get your VCs, who are actually good friends, if you will, who are internal, because their incentive is to keep the valuation lower?
Or is it? So just a question back to you. Why do you think there's such a gap in where you think it is and where they think it is?
The degree of commercialization. So as in our case, we've got, this year we do 2 to 3 million. So their argument is that you have to, given the market circumstances right now, the market is wanting more revenue of that for a more robust Series A. Now, whether that's true or not, you can argue back and forth, but it also depends upon one's view of how important the technology is that you've built. And, what big problem are you solving? What's the potential revenue stream down the road?
Okay. It's a really interesting question. So maybe they're crap VCs, but I don't know if they really truly have an incentive to keep the valuation down. It's probably not good for anybody. Like, I think sometimes there's a disconnect between where founders or management teams believe they are and where VCs who are in the market every day believes they are. So that's fine. It's just a mismatch of opinion. The way to get a correct answer, if you like, is just to go out to the market. So if you believe that your valuation is X, get somebody else to tell you that. And then your investors can decide. I mean, if they're stupid, they'll probably keep trying to push the price down to own more of the business. If they're clever, they'll take in new money at the price that is. But I think that's a good way. It's kind of a good litmus test. I just don't listen to them, basically. If you really believe if you really believe that the valuation is that much higher than what they're telling you, go out and get somebody else to show them that. But I also encourage you, just sit down with them in a room and say, can you explain to me how you got to this? Particularly right now, I mean, maybe there's a chance that the last round was overvalued and they're trying to do an internal extension or something like that. That's maybe fine. But if you think you can go out and raise external capital and get somebody else to price it, go for it.
I mean, the issue, we already have 3 VCs, and they're all very good quality VCs. So to bring a 4th one in is probably over the top. But at the same time, it's about keeping the others honest. They all want to put more money in, but at the lower valuation. So your advice is well given. But bringing a VC in, is a lot of work. You're redoing all the due diligence as well. So versus what you've just done, even if you have a lot of the information in the data room already.
Well, but do you think the valuation is, so what's the cost benefit? So if you think you go out to the market and you get a valuation that's 20% higher than what they're telling you the business is worth, maybe it's not worth the pain. If you think it's 20% and you want to get rid of some of those investors because you don't need everybody at the table, and you could go out and get new money and clear out your board in a sense, or cram them down. It's just like, play the game you want to play, but it's the cost benefit of the time, the effort, and then also known quantities versus a new person coming in. So if you think the gap is like 80%, maybe it's worth it. If you think it's 15, 20, I wouldn't bother. Get on with building the business.
Can I ask one more question? Yeah, so
No, I actually totally agree with that, so I didn't add anything. Yeah, I think just take it into your own hands, essentially. And to your comment around one more investor being like overkill, I mean, every round you do, you're basically going to bring in a new investor in most cases, unless you've got like a multi-stage fund. I think you basically just sort of fill in at the top and replace at the bottom. The first pre-seed fund will probably start to want to move more into the background anyway, because they need to focus on the new investments. So I think it's quite a natural order of things. But yeah, as Edel said, if it's not worth cost benefit, if it's only a marginal difference, maybe just don't bother.
So just a follow-up question. In terms of DTAC, do you think we've reached a stage in Europe where assuming it's a good deep tech company, does not have to get on a plane to go to New York or LA or San Francisco, that there's enough funding for deep tech investments in Europe at valuations that are at least comparable to the States? Are we still a little ways away from that?
My own personal thoughts, I'm definitely waving the European/UK flag, but I think you get to a certain stage, so probably Series B on, you need to start looking to the US, would be my view.
Yeah, and it depends what type of business you want to build, because I think some businesses have the European angle increasingly now. It's like, we will be the European leader, and therefore raising in Europe makes a lot more sense than actually I need to go to North America to build a big enough business, and therefore I probably want to find US investors. I'd say in general though, once you get to, as Edel said, like once you get to Series B, the investors cross the Atlantic very easily. It's actually quite hard to distinguish, I think, between necessarily like who's an European only, US only. A lot of people are global investors at this point. A lot of the US funds are in Europe, and maybe less vice versa, but definitely that way around. I mean, we had one company raise a Series A recently, and they basically had two term sheets, one from Europe, one from the US, and they did go for the US because they still have that feeling of, we want to open up a new market, and they have that little bit more experience. But I think if you want to build in the US and you want to find demand in Europe, and you want to find demand in Europe, you want to build here, there are investors up to maybe that growth stage to support you for sure. Definitely a Series A, maybe even Series B.
Hi, I'm Sophie, co-founder of Workstream. We're building a construction platform to help companies better manage the finances on their construction project. We're raising pre-seed funds at the minute, and a question that a couple of VCs have asked us is on defensibility, and specifically technical defensibility. At pre-seed stage, I feel like it's hard to prove that, and I was just wondering if you had some examples of good either answers to that or companies you've invested in that you think had good technical defensive ability at that stage.
Yeah,
sorry.
No, go ahead.
Or if it's necessary, should our answer be why we're currently defensible or why we will be defensible?
Yeah, that's what I was going to say. I think it is much more about how you will be defensible. I suppose you're investing in the future outcome, and the reason people ask questions like short term and long term is like the short term is a signal towards the long term, and so I'd say questions on like problem, solution, traction inverted commas, are much more relevant short-term questions. I think defensibility in the short term is like not really a relevant question. I'm conscious that I know my colleagues spoke to you guys recently, and so maybe they asked this question, and I'm like, I don't want to throw them under the bus. No.
We really like Jeff, don't worry.
Yeah, exactly. But yeah, I think thinking about it in like a 5-10 year horizon, that's what's really important. And I think it's interesting because B2B SaaS companies basically don't really have defensibility. And so like the answer there is just execution, really, which is kind of crazy. But then if that is genuinely the answer, and maybe look to some of your comparable companies, what ones you aspire to be like 10 years ahead of you, and say like, okay, well, what would their answer be? And if the answer is just execution, then lean into it and just say like, this is why we will win. It's because we know the customer better, we have a better go-to-market, we have this angle. It's a difficult question, and it splits opinion. Some investors love that question. Some like think it's the stupidest question ever.
I half think it's the stupidest question ever, but so because if that was the case, then there would be like 6 tech companies in the world. Like not every company can be differentiated or defensible from a technical perspective. So to me, if you, why are they asking that? So they're asking that to understand, okay, if there are 10 competitors that pop up in the next 2 years, how do you win? So I would nearly frame your answer around the how do we win, and that speaks more to what moats you can build for yourselves. Sometimes they're going to be technical, and sometimes they won't be. So pick the one. So for example, do you have an unfair advantage because you're from this industry, you've lived the pain, yada, yada, yada. Is it execution? Have you shown that, from day 0 to day 60, results are happening? Whatever it is. So the question, maybe it's an easy out if people don't like kind of B2B SaaS type businesses, but if they're being genuine, it's probably to understand where you'll be kind of in a couple of years. So just build up your answer around what makes you defensible other than the tech, maybe.
I think it's very hard to have like technically defensible businesses these days.
Me too.
To be totally honest, like unless you're a true deep tech company where you've got a patent, and even that like doesn't really stop anyone. So, technical defensibility. I know that was specifically what you asked. Like, I would almost try and avoid it. I think you're end up going down a rabbit hole that you basically just can't win. Yeah.
Cool. Thank you very much. Very useful.
Awesome. Who's next? Sorry. I'll come to you next, Ben.
Sorry, just following on from some of those questions. I'm Sam McDade. I'm a co-founder of BlockBio, a cloud genomics company. And just going back to the question about spending your time talking to different investors. So we're put in a position where people talk to us, we talk to people. How much time do you spend focusing on the people who technically are funds that are in your space or you already know are sort of deep tech interested and already probably very educated in that space versus talking to more general funds who you may have to do more education in terms of your space, and especially around sort of ideas of defensibility versus then more like generic sort of local funds that you might be able to access, which, how do you strike a balance? Because I know if you're not doing one, you're doing what you can only be doing one thing at a time. And how much time do you put into researching the funds before you talk to them versus talking to not as many people as possible, but to enough people so that you cover the whole market?
And this is like, if I were you, what would I be suggesting?
Yeah.
So I think you categorize the 3 types actually quite well there. So yeah, the local players are definitely where I would almost start, because you're going to have the warmest intro, you're going to get the friendliest kind of interactions, it's going to be the least transactional, and they're going to probably point you in a better direction, even if it's not a fit for them. So that's definitely a good starting point. Then going to the specialist funds is very useful because you can skip that first step, the first level. It's like, I understand what you're talking about, let's go a little bit deeper. And that probably requires the most research, and it's probably the most targeted list. And actually, by the time you narrow down what you're doing, it might not be that big a list. Then the generalist funds, there's a few different approaches, so I'd be interested in your opinion, but I do think actually it's worth doing some research on whether or not that generalist fund, even though they claim to be generalist, have actually ever invested in your area. We've tried to get a bit better at that. I said at the very beginning, we basically don't do biotech and gaming. There are 3 or 4 others that we basically haven't invested in, and we've now put on our website as FAQ. We don't really love this space. And so, if a founder saw that on our website, I probably just wouldn't prioritize Playfair for that area, like ad tech, for example. So I think you can do a little bit of research there, so you don't just open your net up to everyone and then you're just speaking to loads of people who are just trying to take a call and just fishing. But that can be hard. That can be hard to allocate that time. So it sort of depends where you are in the fundraising process. At the beginning, it's quite useful discovery just to test the pitch, see where those messages land on someone who isn't educated in your space. So it's kind of like a constant balancing act. And I think that's why it's so helpful to have, close advisors, like the guys here, to be able to go to them. But I'm like a third of the way through. I've spoken to loads of generalists. No one seems to be getting it. And then you can adjust the strategy a bit.
Just a follow-on question in terms of, sorry.
No, you can. Do you want to ask your question?
Carry on.
No, I was just going to say, if I were you, and we've chatted, and I'm a generalist, so sorry, but we do invest in businesses like yours. I think you actually need to do them all. So in the 3 buckets, but you don't need to do everybody in each bucket. So be a bit more targeted. And what I would say is, like, you're going to kiss a lot of frogs. We kiss a lot of frogs. But just as you would do if you were in, like, customer discovery and stuff, like, every single conversation you have, you should come away with it a little bit better on something. So whether that is what are the messages that are getting picked up, whether it's, I keep getting asked this technical defensibility question and it's bollocks, like whatever it is, and then you'll refine your pitch. It'll be much less work when somebody does kind of send an email to you and say, hey, I'm from such and such fund. You'll kind of just have it wrote. So I would just try and, like, in the early days, nearly make a CRM for that, which is, okay, what do I need to get out of this, or what do I need to test here? Particularly if you know you don't really love the fund that much, just like test a bunch of stuff and see where it lands.
Yeah, and just following on, it fits nicely with your answer as well. It's like, how much weight do you put in what you find out about the thesis of, say, the fund versus the individual you meet? Because I think that's an interesting dynamic. So you meet someone, you get on with the person rather than, you know, the fund, for example. And how do you balance expectations, I suppose?
Wait, sorry. So the question is, how do you balance whether you like the fund more or the individual?
Well, so like, you know, you talk to someone from a fund, you like the way the fund operates, etc., their area of interest, but then you don't maybe get on with the individual, or then you meet the person and they're really, you know, you get on well with them. How do you balance that sort of internal narrative?
I would do the dance with everybody.
Yeah.
Like, just do the dance.
Yeah.
And then when you are actually in that fundraising moment, you'll have more options than you would if you put somebody aside, for example, because you don't like the person. I won't take that personally. Or because you don't like the fund. So I would just do the dance. It suits you to keep everybody kind of in your own funnel, and then hopefully you'll have choice at the end of the day, and that's when you decide.
Yeah. I mean, if you don't like the fund, you don't like the funds. That's actually easy. You just deprioritize or use them as a guinea pig, which is fine. I think on the person, so like the way our pipeline process works is like we basically have like a Kanban. It's like new screening, team screening, and then deep dive, and then IC. So like new is like reviewing a deck, screening is taking a first call, and team screening is like taking a second call with someone else on the team and going to like 45 minutes. And between screening and team screening, that's when we have like our longest kind of pipeline discussions as a team. It's like 2 hours twice a week. And the point of it is like whoever's done that first call is actually thinking much more like objectively than subjectively. So like we really try and like separate out how are people judging like how good they think the founder is in terms of like founder market fit, what have they done so far, how do they present the story, lots of the other objective things. It's actually kind of irrelevant whether or not they personally got on with them or they personally like the story. It's then someone on the team's responsibility to say, I feel really passionate about this area, and like it sounds like I actually might really get on with that founder. The second one's harder to gauge, but sometimes you can actually from some like comments and like style things. And then after that, you know, there's normally 2 or 3 people you've met, most of which are the people who could lead your investment, and so you can then start to hone in, and it's a two-way thing. So I get the impression in almost all cases that like, you know, if this person that you've met on the investing side doesn't really get on, but someone else does, like that will just naturally happen. I think at the later you go in the processes, like seed, Series A, etc., the more important it is to find the like partner fit. I think at the earlier stage, probably less important, but still important, because at the end of the day, yes, we only do 6 investments a year, but most pre-seed or seed funds would do like 10, 20, even like 30 a year, and so it's much more of like the fund investing in you with one person like managing the relationship. So in that case, actually, it's more about building a relationship to get you like over the line rather than like building this like 10-year relationship.
Hi folks, I'm Benjamin McGuinness, CEO and co-founder of AirPocket. We are pre-product, pre-revenue, obviously. We're building a platform that allows people to book and plan multi-stop trips in one transaction. What I'm interested in is go-to-market. Now, we believe that the most lucrative, the most exciting route to market is B2C. Just interested in your perspective on B2C at the moment, the investing landscape, As investors yourselves, how do you view the B2C landscape at the moment?
So I'm the worst B2C investor in the entire world. I think it's the hardest thing to do, which is why I don't do it. I like macro, it's a pretty tough environment, but I think given you're so early stage, I wouldn't like let that hold you back from thinking about going out and raising. Like, first thing you need to do is just show that there's something there that people want to use. So even if it's janky, it's stuck together with sellotape, just for your own self, just validate that first. So get it into people's hands, start getting like, you know, signals of how they're engaging, when, what they're kind of using, not using. So just do that like very quickly, I would say. Don't worry about metrics being perfect or anything like that. The earlier stage you are, given kind of the fundraising environment at the moment, that I think the better shape you're in. So basically go for it. You're doing something really, really difficult, but don't let kind of macro stuff hold you back.
Despite not being an expert, it's good advice. It is really good advice. Honestly, like I've thought about leaning more into consumer many times in the last 5 years, and it is really, really hard. And I think in Europe, there's probably like 4 or 5 funds that actually understand it. There's probably 400 funds that understand B2B or understand it more. So like, I think Europe, you know, it's I can't remember who asked about Europe and deep tech. You know, that's actually pretty close. I'd say like consumer is so far behind. We just don't have the experience in the ecosystem to know how to like fund, support these types of companies. So either, well, both, go and find those 3 or 4 people. I'll try to remember them, so maybe I'll come up to you afterwards if you don't know who they are already. But then probably I would lean into the US angle. You know, like I really would try and like find more support there. Whether or not it's through the angel connections, maybe there's like, you know, going through some kind of accelerator or something like that, because I think there just probably isn't that support here as much as you might need. But otherwise, I think like the kind of early advice was spot on. Yeah, the only other comment I'd make is we did one consumer investment relatively recently, which is now pivoting to B2B, which tells you something. I just think like the cost of acquisition has just gone crazy, and like everything that everyone knew, you know, like optimizing, you know, the different like Facebook, Google spends and all these, it just doesn't work anymore. And I think people are a little bit stuck on like what the next phase is. So to your question around like go to market, I think you have to be quite creative now to like creative, but also there's an opportunity because clearly people don't know what that next like playbook is. So if you can kind of ride that next wave, that could be interesting. But yeah, sorry not to be more helpful than that.
Thanks. Who's next? Yep, good man.
How much homework should you expect to have to do for a VC before they at least indicate that they're serious about investing? Because we've found a lot of investors simply want us to do a whole ton of paperwork, and then it turns out they were never really serious. And I guess we're getting better at smoking those out, but you know.
You mean like in an active fundraising process?
Yes. So, you know, just tons of documents about strategy documents, finance documents, often very specific. They're not always asking for the same documents, so each one you have to go and do a ton of work, and so it's just like, how do you smoke that out, I guess, is the question.
I guess my question back to you is, what makes you think they weren't serious if they went through all of that homework themselves?
Well, I've learned a bit about that over time, and often, like, one thing is analysts just have a list, and they just go through the list, and if you're only talking at analyst level, then you don't know, and you need to try and get above that level to get a sense whether it would be a serious player. They're simply trying to, you know, fill up their story so that when they go to the next meeting, they can take it there. And I think it's really important to try and figure out whether this is an investor where there would be in principle a good fit, subject to all the due diligence and the documents that you need to provide.
Yeah, maybe that's the answer to the question, which is you're not dealing with the right person in the fund. So basically, maybe not your first call, but definitely your second call. You want to be on with somebody that can lead the deal and would be the person taking a board seat if that's what happens with the round. So that's a pretty good way for you to filter them out. I think other than that, it's like I'm pretty upfront. Henrik's pretty upfront. Most people I know aren't going to make you do work for the sake of it. So if you've kind of built enough of a relationship with somebody, you say, hey, you're kind of asking me to do a bunch of stuff here and I've no idea what's happening. You can sort of say, what does your IC process look like? You know, how long would it typically take for you to get through the first set of documents in the data room? What happens next? Like, I don't mind when somebody's pushy to say, hey, the docs are here, why don't we set up a call for like next Tuesday and discuss, or if you got other questions and stuff. So maybe just feel free to take a bit more control in the process. Say, you know, I'm super happy to do all this, but like, I really need to know when you think this is going to be potential for investment committee. And just make sure, definitely second, at a minimum, the third call, you want to be dealing with the person that's going to lead the deal, I think.
Yeah, I'd also add, like to the data room question earlier, this can help you a little bit, that if you spend more time preparing the data room, because if your data room is like 90% there, then actually you can just keep directing people like, well, it's just in the data room. And you kind of flip it a little bit. If the data room is light, then actually the investor is much more legitimized in saying, I've been in your data room already and I couldn't find X, and so could you provide it to me like custom? Whereas if you basically provide, you know, a version of your pipeline, and it's not exactly what they wanted, but you say, look, like it's in the data room, you know, I don't actually, you know, can you like be really specific about like which part of it? It just suddenly makes that request a little bit narrower, rather than them just presenting you with like a giant list of questions. Because if an analyst at a fund sends you 30 questions and you reply saying, well, most of that's in the data room, they'll feel like the idiot, not you feeling like the person who has to do all that work. And then hopefully if that fund's well run, like the person who could potentially lead, who's working with that analyst, will be like, well, why did you just send that list of questions? It's in the data room. So you can see how you can start to control the narrative a little bit. And then, I just echo the point around like transparency of process. Like the VCs, the worse the VC, the more untransparent or opaque the process they'll try and make it, because they don't have control over it, or there's something going on. So it's totally in your right to push that and say, please do outline, like, when's the partner meeting? Is usually what most people call it. When's the IC? What does IC mean? Because a lot of funds have like multiple ICs and they all mean different things, and that can be very confusing. And some founders I've found actually confuse certain meetings with an IC when it's not actually an IC.
So push them on process.
Really push them on process. And if you don't understand it, then keep asking until you do. Yeah.
I have one other question, by the way, completely separate, which is, as you move through the rounds to Series A, Series B, obviously founders find themselves getting very diluted. How do you keep them motivated?
Just hope they're not diluted too much. Like, that's just...
Is that a factor in how you
game.
create a valuation?
I don't know. Yes and no. So I wouldn't arrive at a valuation just so that a founder or a set of founders are above or below a threshold. You come up with a valuation that's sensible, and then you look at the impact on founders or, you know, early investors, et cetera, because the one thing that you really need going into a later stage journey is alignment. And, you know, if you have 3 or 4 existing investors, you had 3 co-founders in the beginning, one of them's gone, one of them's on the way out, and the main founder who's running the show has like 5%, like, I wouldn't do it. Yep. So I think it depends on how sensitive a founder is to dilution. It depends on how good a job they're doing, to be frank. So if you need to bring in additional people into the management team, you need to make sure that there's a pretty big ESOP there to attract those folks in. And if that's going to dilute a founder more than they want, well then that's probably not going to be the alignment that you're looking for on the next phase of growth. So I think it's a bit of a balancing act. Nobody wants founders to feel like they're kind of slaves to the business. You know, you've worked hard to get it where it is. Can you be there at the next stage of growth? And then what's it going to take to keep you motivated? So it's a really kind of all over the place answer, but I don't think anybody, well, good VCs certainly don't go into it saying, oh, this is great, we're going to dilute the shit out of this founder. Like, that's not really, that's not going to be a good start to a, you know, very long-term relationship.
Yeah, and I just, give some rough thresholds, dangerous, but it's more useful than not. Because we're coming from the other perspective. We're like, okay, well, when we send this company to like our Series A friends, like, what is the thing that's gonna like, what's the threshold below which people are gonna be like, oh, that's an amber flag, or like even a red flag? I'd say like, from all the companies we've seen, above 60% like founder ownership is like ideal. You know, if as the founders you're going into Series A and you own 60% between you, that's ideal. No one's gonna have an issue with that. Below 50, it starts to become a bit more of like a flag. So like you really want to try and stay above that. Obviously there's differences and situation and blah, blah, blah. But like when you play through the scenarios of like raising an angel round or pre-seed and a seed round plus option pools, like that's kind of where it comes out. And so I suppose that's where it becomes important on like managing those first early round like strategies and things. And the final point is if you have a pre-seed or a seed fund that does take you to town and like dilutes the shit out of you because whatever, it's COVID and they can because it's the only term sheet and that kind of stuff happened, then we still get screwed because the Series A fund will come in and say, well, the founder doesn't have enough ownership. We need to incentivize them, so we're going to re-up them with like, founder re-upping. And that's happened actually in a couple of rounds we've had, even if it, not through any fault of our own, it was just, we ended up having to raise more because of the bridge round. So like, what? I hope the fans wouldn't accuse us of having tried to take them to lunch, but I think it was more unintended. But they did have too little ownership, and that was fine, and it balanced itself out.
So you get diluted down.
Well, everyone on the cap table does,
yeah.
But obviously the founders then being given those shares that they don't, and that's entirely fair, I think.
Do you agree with those numbers, by the way, 60%, 50%?
By Series A, that actually seems quite high to me. But that's okay. Maybe we do want to dilute the shit out of it. No, that does seem a little high, but I think it honestly it just depends. Like there are some businesses that we've gone into, say, in the last 2 years, that have been on the go for like a long time, like 7 years, let's call it, and multiple rounds and extension rounds and the whole lot. But that's why I would just want to say the last thing was on, you can negotiate with your new investor around re-upping yourself. It's a really, really annoying trait, I will say, if you come to Series A and that's the immediate ask of a founder, and they're going to ask for the same thing at Series B and the same thing at Series C. So like, it's give and take. Do you want to be building a big business that you have, 15-20% ownership in, or do you want to own 80% of something that you don't have, external capital behind you to help scale? So, it's give and take, I would say. But you can negotiate for a re-up, no problem.
One more question. Come on. Someone. Yusuf. Danny. There we go. Danny's good man.
Hi, Danny Stewart from Workstream, co-founder of Sophie. One question I wanted to ask both of you, and given the context, you now know the relationship, don't take this personal. I just want to know, was there anything in particular that you have passed up on the past that you regretted? And if so, what was the sort of deciding factor that made you not go with that?
No, I've never done.
I'm a genius. I mean, I've got a story I could start with. If this is I don't actually know now where this lands. But I remember going to an event in late 2019. So it was like my first year at Playfair. I really didn't know what I was doing. I still don't, but I definitely didn't then. And I went to this random event, which I would never go to now, because I just wouldn't prioritize it, and met this company. They were trying to do this like online events thing. I was like, it's just a stupid idea. And I remember going to breakfast with an investor who I now spend a lot of time with, and they were telling me about the hottest round and whatever, and it was the same company. I was like, it's a stupid idea. It actually came through our website as well. We passed on it, thought it was a stupid idea. And for 2 years, I looked like a massive idiot because it was Hopin. And Hopin then like raised loads of money and was huge, and it was like the company. And I told everyone it was a stupid idea because I was like, well, I'm going to show that I have an opinion. And it was a very strong opinion. It was very wrong for a long time. And now I actually don't know. Like maybe that company just went in the wrong direction. That's why it failed. But I think the point of the story is not that I was like right or wrong. It's more that like this is like a 10-year journey, And so like it's basically impossible to know you're right or wrong. Like the average tenure of like most VCs is 7 years. So it's not even as long as most companies take to exit, or even how long their like funds are alive. So yeah, we all have our anti-portfolios. I think it's really cool, the funds that talk more about them. Like is it Bessemer that put them all on their website? I think they put like the antithesis memos of all of them as well. And like maybe we'll try and do that one day. I think that'd be a really cool thing to do. But you only need one. You only need one person to believe in you, right? So.
So I'm actually not joking, but I don't feel that way about any companies really. I definitely feel upset about the ones that I lost, particularly the ones that have turned out to be, 10x businesses in 3 years. So, there are regrets. And then there's a funny thing where I think emotionally you have to check yourself. So, for example, if I was you with that hop-in round, I'd be like, oh man, I really got that wrong. But actually, I would be using an external validation to give me that feeling, which is somebody else that's a big fund, that's smarter than me, saw something here that I didn't see. And I sometimes feel that when I've passed on things and, a really tier 1 US VC does the round, but it doesn't mean that I was wrong. Do you know what I mean? Because it takes so long for it to play out. So maybe I will be wrong on a few of those, but I more regret the ones that I wanted to do that I didn't win.
Just as a remark, as an angel investor, I passed on Spotify at 10 million valuation.
Was it too expensive?
It was too expensive. This is 25 years ago when they just had an idea. And they actually came to London. 10 million for a startup that has had nothing at the start. It was too rich. So I don't think too much about it. But I do have a question in terms of your experiences in changing co-founders. So one of the VCs that we're involved with, their record, I remember deals, 60% of companies have to have a change of co-founder just before, say, Series A or around that time, if you will. What's been your experience? And also, what happens in your experience when you have a co-founder that's actually very, very good, but in the wrong position and doesn't want to move, doesn't want to recognize that, what sort of experiences you had to move people along?
I mean, I think it's very common for the co-founding team, the initial co-founding team, to not survive in its entirety post Series A, or to Series B maybe would be a better way of putting it, into the growth phase. I think it's really hard to have multiple people all aligned in their professional life, their personal life, where the business goes. It's a really, really difficult thing to keep together. I'd say that if you said 60%, that does still feel quite high to me. I'd say maybe it's a third, that would lose one co-founder, or co-founder would change or become a little more in the background or something. So still the majority that do survive to that point, but there's a good amount that don't. And so I don't think it's that much of it's not a disaster. It doesn't mean your company's not going to work out. I think you just have to play it through. They are always difficult discussions. They're always painful. There's always a lot of emotion. It's very useful to have a third party to kind of manage that so that it becomes less personal. That can be an investor figure. That can be someone entirely external. That is really important. Yeah, I don't know. That's just a little bit of extra context, I suppose. I hope that helps a bit.
Yeah, maybe just to add, again, unless you're a horrible VC, nobody wants to be the person that's saying you, co-founder, CEO, need to move. It's very emotional. It's really, really hard for the people involved. You're kind of married to the people that you start a business with, and all of a sudden somebody says they don't want to be with you anymore, or you say to them, actually, you're crap, get out. That can take a huge emotional toll, but it's not uncommon. So I think the better situation would be, I'd be interested in this fund, causation or correlation. So is it a case of, they have a view of the world that doesn't match the view of the founding team, and therefore they're sticking their boots in and saying you need to change? Or is it just a fact that, I don't know, maybe there aren't enough repeat founders, for example, coming through the portfolio that have done it before, that are, shorten the kind of learning curves and learning cycles. So, like, I don't know, but nobody wants to be that guy pushing founders out of leadership roles. I think if it does happen, it should be founder-led. And I believe that it's much better for everybody if a certain co-founder is really, really good at something. Maybe they're an evangelist, maybe they're really good at just building stuff. Try and find a place for them to succeed at what they're really, really good at within the business. And it's a much nicer situation for everybody to be in.
But egos, like, we all have egos. We all try and pretend we don't, but it's really hard for someone to take that ego knock of like, I was co-founder and now I am just lead engineer or like product something, you know? And even if it makes entire sense for them to do that, because that's actually what they love and that's what they're going to go and do somewhere else, it's really hard for them to actually accept it, which is a shame, I think. But the expectation, I would say, in like 90% of cases is that they will just end up leaving eventually. So maybe short circuit that. You know, try. That's a good thing to have tried, but I would not expect many people to actually take themselves out of a leadership position and stay and be happy. That would be unusual, I think.
Last one.
Sorry, really quick. What do you think is some of the most useful ways to spend the money at pre-seed? So, for example, we're trying to raise 750K. What do you think are some of the best ways to spend that?
That's a good question. It really, really depends on the business. But if I'm trying to generalize,
we have a product and we have 3 customers. So we want to like improve the product and we want to get as many customers as quickly as possible. But we obviously want to grow and scale.
Yeah, I think getting to a point where your product can be close enough to like 80% of like the solution that solves the problem. So like whatever engineering resource you need to get to that. So go from an MVP, which might be at 20% of the solution, it's like 80. Yeah. And then don't focus about like maybe quantity or total of sales. It's like, can I prove something that can then be replicated? You know, so if that requires hiring no salespeople, maybe it's literally just you or whoever's like the commercial co-founder, and then maybe it's customer success, because actually like the type of sale you're doing to prove the value is really like a land and expand model. Then maybe that is the one person you should hire. But what you're essentially proving is that solution can be sold, can be bought. There's budget for it. People then love it and will talk about it. So it's always bringing you back to like the first principles, weirdly, which is, yeah, you're not trying to like throw money at like marketing or just hire salespeople just to get sales. It's like really trying to solve the like core problem, and do that in like the leanest possible way. Hopefully that's helpful.
Very clear. Yeah. Thank you so much.
Yeah. The only thing I would say is think about the milestones that you need to hit to unlock the next round, and then work your way backwards and give yourself enough time to achieve those. And I totally agree. That was the first thing in my mind is like, don't over-engineer the product. Good is good enough. If you can show that people want to use it, like that's like 90% of the hard work done in a sense. And you can always raise more funding later to build that out or perfect it, or, you know, go a little bit more horizontal if it's like a platform play. But just get it into people's hands, show that they like it, and then start thinking about the next round and just literally go backwards.
I think that's the thing, like we're always embarrassed by our product and thinking that we're the only co-founders that are. And now the more that we've talked to people who are like Series A, Series B, they're like, we're just waiting for the day that it all falls apart. And so it's getting used to that and then just going with it anyway. Thank you very much.
Brilliant. No, you're okay. Don't be silly. No, it's great. Okay, I'm just conscious of time, so hopefully that was helpful, guys. We're going to be doing probably lots more. We have one maybe lined up for November, so I'll keep you all posted. The guys are here. They can connect. There's no warm intros needed. They're right in front of you, so go say hi. And yeah, let's give them a little hand. Awesome.
Great questions. Thanks, guys.
Thanks, everyone.